Good morning. This is about my seventh try for this little presentation. I'd be embarrassed if you knew how long it took me to do this little tiny slideshow, but I'm going to try again. The noise in the background, they're doing some work on the neighbor's house, so excuse me and excuse the neighbors. Our opinion, auditor's responsibility to obtain reasonable assurance about whether we know that. Make sure we're aware that auditor's responsibility section of the audit report, our objectives are to obtain reasonable assurance about whether the financial statements as a whole are free of material misstatement, whether due to fraud or error. Up till that point, that's exactly word for word the same as AU Section 200. Now, it's a little different from there, whether due to fraud or error, and to issue an auditor's report that includes our opinion. 200, on the other hand, says, let me get my pointer up here, there we go, says thereby enabling the auditor to express an opinion on whether the financial statements are fairly presented in all material respects. So they're very, very similar. Now, because I have a limited memory, a very limited memory, I'm probably going to learn one or the other and substitute them. I might lose a point or two here or there, but my goal in life is not to get 100%. My goal in life is to be right almost all the time. So make sure you know the familiarity or the similarity between the auditor's responsibility section of the audit report and AU Section 200. Reasonable assurance, another word that comes up in the auditor's responsibility section. Reasonable assurance is a high level, but not an absolute level of assurance. Okay, so that's what we've got to learn. That's in green. A reasonable assurance is a high, but not absolute level of assurance. Therefore, it's not a guarantee that the audit will detect all material misstatements every time. And also we should point out the risk of detecting material misstatements from fraud is higher than the risk of not detecting a material misstatement for error, because fraud, the intention of the perpetrator is to hide the fraud from us, whereas an error, management is likely going to try and help us find errors, but if they've committed a fraud, they won't help us find that. We're focused on the assertions in the upper right-hand corner, those 6 assertions in the red block. There's only 6. I want you to spend some time and learn them because they're going to be on all 4 exams. Okay. We'll add some more later, but initially we're talking about those upper right-hand corner. The reason there's 2 columns is we typically audit transactions differently than account balances. This is from KPMG. They used this slide many years ago. I like it. I'm over here in this audit approach section. Notice we've got classes of transactions and account balances. And the reason they're separate is we audit them differently. Typically, when we're auditing transactions, not always, but typically we're auditing the internal controls. Typically, when we're auditing account balances, not always, we're taking a substantive approach. So that's why there's 2 columns. Now, previously, the AICPA had 3 columns, one for transactions, one for balances, and one for disclosures. Now they've combined transactions and disclosures, account balances and disclosures. We're going to talk a little bit about estimates later on because we tend to audit estimates differently also. Fraud is a whole different game. Audit objectives. Tad's going to treat the assertions as kind of surrogates for our audit objectives. Hopefully you'll start seeing that, but they're very, very important. Significant classes of transaction and financial statement cycles. So on figure 6.4, we're going to focus this quarter on sales and cash receipts. Sales go into the sales journal, cash receipts go into the cash receipts journal. They flow into the general ledger, the trial balance, and the financial statements. But I want you to be aware that those aren't the only two classes of transaction. Even a small company is going to have purchases or acquisitions, cash disbursements, payroll. So companies are going to have more than these two classes of transactions, but we're going to focus on those two in this class, at least initially. Revenue and collection cycle, credit sales, cash receipts. Credit sales and cash receipts. Now, that is a cycle. We're going to put them together today. Credit sale is a class of transactions. So in our world, credit sales is a class of transactions, so are cash receipts. But when we put them together, we create a cycle. Remember in 214, every accounting teacher in the world teaches, if liabilities equal 20 and owner's equity equals 10, what do total assets equal? If total assets equal 30 and owner's equity equals 10, what do liability? And the cycle, the accounting cycle is, if I know two of the values, I can solve for the third. That's what we're looking for. We're looking for accounts, classes of transaction that are related, where if we know something about two of them, it will help us audit the third. If we know something about three of them, it'll help us audit the fourth. This quarter, we're going to talk about cash receipts, accounts receivable, and sales. Now, if you don't know what a sales journal is, instead of using the general journal back in the old days, hopefully you can see this little sales journal makes it much easier to record hundreds of entries if we're doing it with a paper and pencil than if we were using a general journal. So instead of using a general journal for sales, many companies used a sales journal. And then periodically they would post from the sales journal, we're going to debit accounts receivable 1205 and credit cash debit accounts receivable 1205 and credit sales 1205. Similarly, they'd use a cash receipts journal. Rather than making a full journal entry in the general journal, they might have a cash receipts journal. And again, they would periodically post debit cash 3165 and credit accounts receivable 3165. I don't know whether a sales journal and a cash receipts journal make all that much sense in an accounting system that's based off a relational database. But I do know if you ask for a sales journal, they'll provide you with one. So regardless of whether it's critical for the structure of the database, companies still, at least verbally, use sales journals and cash receipts journals. Now, why this makes a cycle to us, we're going to treat cash receipts, the debit column to cash, as a separate account from the credit column to cash. And by doing that, if we can have a relationship between cash receipts and sales. So it's very difficult to audit sales. These are gone. This is the inventory we sold. We can't observe that transaction. It happened a long time ago. Yeah, there's documents to support it, but it happened a long time ago, and we can't observe it. And there's a lot of transactions that we'd have to audit. Now, accounts receivable and many balances are much easier to audit. If we think of accounts receivable, it's kind of like, oh, they debited this much when they had those sales. Oh, here they collected the cash, it goes away. They debit, credit, debit, credit, debit, credit. So effectively, the balance in accounts receivable is pretty much the last 45 days sales that haven't been collected yet. So auditing accounts receivable is much less, requires far fewer transactions or accounts to audit than sales would. So this is not easy, but relative to sales, it's easier to audit accounts receivable. Cash receipts, on the other hand, are really easy to audit. I mean, the balance is really easy, right? We just get the December 31st bank statement and reconcile the balance in the books to the balance per the bank statement. But like I said, we're going to split cash into receipts and disbursements, and we're going to audit the receipts separately. But they're still easy to audit because every month the bank sends me a letter and tells me what my cash receipts were for the month and my cash disbursements. But I'm worried about cash receipts here. Now, if I know my cash receipts and I know the ending balance in accounts receivable is correct, I can estimate what my maximum sales were for the period, because I always remember that cash equal beginning accounts receivable plus sales minus ending accounts receivable. Or you might have learned cash receipts equal sales plus or minus the change in accounts receivable. However, you should realize there's a relationship between sales, accounts receivable, and cash receipts. I'm going to take advantage of that. That's why I'm going to call this a cycle, the sales and collection cycle. Tad's favorite page in the whole book. These are the 6 management assertions we're going to talk about. And notice it's transactions and disclosures, balances and disclosures. Tad's going to be careless and he's going to talk about the column for transactions and the column for balances. But the truth is it's transactions and disclosures and balances and disclosures. We're going to use the assertions to help us create objectives, audit objectives. I'm pausing here, not to collect my thoughts, but for you to think, what is an audit objective? When you set an objective, what's that mean? So we're talking about sales revenue now. Now I'm on page 167 in the book. Not worried about this stuff up here. I'm down at the lower part. 1, occurrence. Okay. Did the sale actually occur? Now, the assertions are for all types of transactions. We're going to worry about sales, but the assertions relate to all kinds of transactions. Okay. So occurrence. Does everybody agree that if they record a sale that didn't actually occur, we've got a problem? Completeness. Okay. That all transactions that occurred actually got recorded. I want to stop for a minute. Think about completeness. If a transaction is recorded in the sales journal, we don't have to worry about completeness, do we? Because completeness says I'm worried about a transaction that occurred and didn't get recorded. So if a transaction got recorded, then I don't have to worry about completeness. Does that make sense? And third, accuracy. So Tad kind of goes with completeness first, then occurrence, and if it's not completeness or occurrence, then I look for accuracy. So get those straight in your head. Spend a lot of time. There's not much reading for this section, so spend some time learning and thinking. 321, what did we learn about sales? The 5 steps: identify the contract, identify the performance obligation. What's that? Our obligations to deliver the product to the customer. Determine the transaction price, allocate the transaction price to the different performance obligations. Well, we're not going to do multiple performance obligations. How much are we going to actually receive from the customer? And when do we recognize revenue? When we satisfy the performance obligation, when the delivery has occurred. So you learned that in 321. You're supposed to still know it. So think about the 5 steps to revenue recognition. You can't audit revenue. You can't audit sales if you don't know what a sale is. So what you learn in 321 is important after all. Now, page 169, table 6.4, the book's going to convert from the assertions, which are general. The assertions relate to all classes of transactions, but we have to say, oh, can we tweak that? What's occurred mean for a sale? And over here they say a recorded sale is for shipments made to non-fictitious customers. Okay, so I buy that. What's a sale? Well, we satisfied the performance obligation. We've delivered the goods to a customer, a real customer. Completeness. Existing sales are recorded. Oh, I hate that. Existing relates to balances. So I'd rather they used all sales that occurred are recorded. We relate occurrence to transaction. We relate existence to balances. So, it's not all bad, but I'm going to prefer all sales that occurred are recorded. Accuracy. Well, we recorded the quantity shipped correctly and the price that we sold it to the customer correctly. So usually when we're talking about accuracy, at least in this class, we're going to be talking about, did they get the quantity right? Did they get the price right? Balance sheet objectives. Now, if TAD was good, it would say balance sheet and related disclosures. I'm not that good. Existence, completeness. Again, these are the 2 big ones in Tad's mind, completeness and existence. Completeness. If something's recorded on the balance sheet or the general ledger, I don't have to worry about completeness. Completeness is things that exist that aren't recorded. So if it's recorded, I don't have to worry about completeness. Existence, on the other hand, is, guys, it's recorded, but does it actually exist? Okay, does that make sense? So I look at existence and completeness first, but if it's included on the balance sheet, I don't have to worry about completeness. Completeness is for things that exist and didn't get recorded. Get those straight. They're almost opposites. And then we've got accuracy, valuation, and allocation. And a big part with this, the book talks about the accuracy portion, and that's fine. I don't disagree with the book at all about that. But what is valuation? Accuracy, valuation, and allocation. Valuation are those accounts you learned in 321. How do we record? How do we value investments? Well, we value them at market value unless they're debt securities that are held to maturity. How do we value accounts receivable? At net realizable value. So there's a valuation adjustment that you learned for bad debt expense in 321. How do we value inventory? Well, if it's LIFO, it's lower of cost or market. If it's FIFO or average cost, it would be lower of cost or net realizable value. And in 321, you learned those adjusting entries. Those are valuation accounts and allocations. So those are the big three for the balance. Stop and think of what objectives mean. If our audit objectives are based on the management assertions, then for each and every significant class of transaction, the auditor must obtain sufficient appropriate evidence to support each management assertion related to that class of transactions. Does that make sense? If it's our objective, then we need evidence to support, to achieve that objective. Similarly, for assets and balance sheet accounts, if our objectives are based on management assertions, then for each significant account balance, okay, if the management assertion is a surrogate for our objective, then to achieve that objective, we must obtain sufficient appropriate evidence to support that management assertion for that account balance. Does that make sense? So we're going to treat our assertions as if they're objectives. In order to achieve our audit objective, we need evidence, sufficient appropriate evidence. Think that through. Okay, that's not as easy as it may sound. Now for inventory on page 172, and I think I agree with the book. I think it's usually easier for me to think about inventory than it is accounts receivable. We'll circle back. My assertions are general. They relate to all account balances. I have to tweak them and make them specific to inventory. Okay. Existence. All recorded inventory exists at the balance sheet date. Completeness. All inventory that exists has been counted and included in the inventory balance. Accuracy, valuation, and allocation. Inventory quantities on the perpetual records agree with the items physically on hand. Prices used to value inventory are correct. The extension of price times quantity is correct. Now, again, here's a little pet peeve of mine. Prices are what we sell things for, cost are what we pay for them. So I believe inventory's on the books at cost, not prices. But that's kind of trivial. But I do think generally when we talk about cost, that's what they paid for the inventory. Price is what they sell it for. Just a little pet peeve, but you're stuck with me for the next 10 weeks, so you might as well become familiar with my pet peeves. If we go way back in the book, later in the quarter, we're going to talk about the audit objectives for accounts receivable. The assertion, the specific objective, so we tweak the assertion, existence, the accounts receivable on the aged trial balance actually exist. Completeness, all existing accounts receivable are included in the aged trial balance. I'm happy. Accuracy, valuation, accounts receivable are stated at net realizable value. Ooh, that's a valuation. I learned that in 321. Now again, just to think, this is way back, this is chapter, 16, so don't have to worry about this, but think about it. Accounts receivable exists. What's it mean that an accounts receivable exists? I think an accounts receivable means our client has a legal claim to receive the money from their customer. Does that make sense? So, this is probably good enough for where we're going, but think about what's it mean that an accounts receivable exists. Somebody owes the money. They have a legal claim to that money. 500, one of Tad's favorites. Now you got to watch me here. I'm stumbling. This is why this one slide is why I had to spend all this time redoing today's lecture because this is new. Oh gosh, when I review the old test, is it going to be different? Yeah. So as you study the old exams, you should study, but as you use the old exams to guide your studying, make sure you understand, oh, 500 was different on the exams that are available for you to study uh, than it currently is. There's been a change. And the objective now is to evaluate information to be used as audit evidence. Evaluate the information, including the results of audit procedures. Well, that kind of makes sense to me because we're going to subject that information to audit procedures to inform the auditor's overall conclusion about whether sufficient appropriate evidence has been obtained. Oh gosh, what's that last sentence in the basis for opinion section? It's something about we believe that our audit evidence is sufficient and appropriate to be used as a basis for our conclusion. Yeah. So anyway, 500, it's word for word, thou shalt know it. It's one of Tad's favorites. Probably be on all four. Probably. There'll be something about 500 on all four tests. Okay. Professional skepticism. So the thing at the top is out of the Auditor's Responsibility section of the report. Exercise professional judgment and maintain professional skepticism, whatever that means. Well, that's a threefer, right? An attitude that includes a questioning mind. 1. 2. Being alert to conditions that may indicate possible misstatement. Okay. Not indicate, but may indicate possible. Even if it indicates a possible misstatement, we have to think about it. 3, critical assessment of audit evidence. So professional skepticism is a biggie, and we're going to find out that's really, really tough for audit professionals. Really, really tough. So 3, 1, an attitude includes a questioning mind. 2, being alert to conditions that may indicate possible misstatement. 3, critical assessment of audit evidence. Okay, that wraps up day 3. I'm hoping I finally have this lecture done and don't have to redo it again. I'll see you tomorrow and have